Following on from the UK's EU referendum on the 23rd of June and that big volatile day on the 24th, we've seen the FTSE 100 gain more than the point it was at when we went into the referendum, but the FTSE 250 continues to lag. Richard Hunter joins us now from Wilson King Investment Management with some more analysis of this. Richard, welcome. First of all, why has the FTSE gained so much and the FTSE 250 lagged so much behind where it was before the referendum?
It's very much a question of the constituency of both indices. The FTSE 250 much more domestically focused. As such, that's where the real pain has been felt because of the uncertainty surrounding the UK economy going forward in terms of whatever trade deals need to be negotiated and so on. FTSE 100, on the other hand, apart from the brass plate over the door, the vast majority of the companies on the FTSE 100 have overseas earnings. And the weakness of sterling has meant that the quality of those earnings will improve when they repatriate their profits back to the UK. Added to that, quite apart from the fact that you've got a number of mining stocks, for example, oil stocks, etc., in the index. Added to that, particularly in those first few days after the surprise referendum result, there were a number of investors moving into defensive stocks, quality blue chips, you know, the ones that are going to be there in Buffett terms for some considerable years to come. So that buying pressure is certainly a factor, but without question the main factor has been the weakness of sterling.
Well, let's follow up that. In that case, talk about where sterling is, because when a currency drops, it quite often reflects the health of the economy. Why has sterling fallen so much? Yes, we've got the uncertainty. Yes, we've got the concerns about the future direction. Politically, to some degree, that's been sorted out, at the moment at least. And sterling is gaining a little bit today, but it's still not too far away from 31-year lows against the dollar. This surely indicates an big underlying issue, doesn't it?
Yes, and there has been a lot of speculation, almost philosophical speculation in the market as to the fact that the UK has been, for want of a better expression, picked on as a result of the Brexit vote, when of course you've only got to look around some of the peripheral EU countries to see that the UK is in a pretty good position compared to, you know, the high youth unemployment in the likes of Spain. We know about the Italian banks. Slightly mixed signals coming out of Germany as well, let alone whether we could see some kind of domino effect with the UK having left, and there's already admittedly only anecdotal evidence that a couple of countries may be considering it. So in over a period of time we may well find that it's the Eurozone which begins to take, and therefore the Euro, which begins to take a bit more pain, particularly when we've ticked a few of our boxes, and you're absolutely right, the fact we now know who the new PM is going to be means that one of those boxes has been checked.
You mentioned Italian banks. What's the health of British banks like? I mean, we hear now a lot about Lloyds now no longer likely to see our ownership, if you like, sold back into the market. RBS, of course, is a long way from that anyway. What's the health of British banking like?
The problem with the banks is not so much their capital buffers, because they've been working very hard in terms of the Basel requirements to make sure that the capital cushion is there and healthy. That isn't the issue. I think that the main two issues surrounding the banks at the moment are the ongoing regulatory fines, regulatory censure and regulatory cost. That's obviously not peculiar to UK banks, but that's certainly something that's weighing. And of course the other one is interest rates, and in a low interest rate environment it's very difficult for the bank to achieve positive jaws, as they call it, in other words making money, and needless to say, in anticipation of a further rate cut in the UK later in the week, that's put additional pressure on the banks as well.
Yeah, that takes us into another area I want to discuss, is this interest rate particular area. Do you seriously think it's likely to happen this week, or do you think we'll wait until August when we get the inflation report out as well? We said that's Super Thursday, I think the first Thursday of the month in August.
Well, in normal circumstances I would say it's almost certain on the basis the market is pricing in an 80% probability. Having said that, I think...
of a 25 basis point cut?
Yes.
Right, because I have seen it, possibly a 50 basis point cut down to zero.
That may well come. It's been taken positively that the Bank of England have already said they're prepared to stand behind the economy as and when necessary. The only problem I've got with the market consensus of 80% at the moment is that's a similar sort of level to it was that we'd be staying within the EU. So we'll wait and see for sure on Thursday.
So you say the markets are pricing in a rate cut. If a rate cut doesn't happen, is that going to spell problems for the markets?
It should actually be reasonably positive for sterling, but inevitably, when the dust settles, we will then need to be considering whether the Bank of England actually thinks that the uncertainty which is being created at the moment, both in terms of investment by companies, spending by consumers and so on, isn't that much of an issue, that the Bank of England didn't feel it necessary to make some kind of gesture. And if you kind of step back from the current situation and the anecdotal stories we're already starting to get, that would very much point towards a rate cut.
Yeah, we've spoken a lot about FTSE 100, the sectors and the companies and so forth. What about the FTSE 250? As I said at the top, and you explained why this has been underperformance, the FTSE 250 against the 100. What do you like about the FTSE 250 stocks at the moment? What is it about the areas of it where you think there's going to be money to be made? What sectors should we be watching for?
Well, inevitably we had that knee-jerk reaction. We had, the 250 down 7%, I think, on the 24th, and another 7% the day after. It's recouped some of its poise since then. But it is, as much as the UK is internationally focused, a play on the UK economy. So at this moment in time, and don't forget there's companies in the 250 which will fairly recently have dropped out of the 100, so there's some quality companies in there. So I think the thing to bear in mind with the FTSE 250 is, as the UK story unfolds, that's the place you want to be looking, along with sterling, for any signs of recovery.
Such as what? Because we've been talking a lot recently about the big drop in the likes of Housebuilders, for example, and some of the other players like that, which is dependent on the consumer. Do you see there's a lot of advantage in going in at the moment, or would you want to see a little bit more over the summers, depending on how things unfold?
Now is always the most difficult time to invest. That's an old market adage, and it remains as true today as it ever did. The question with house builders is whether the sell-off has been slightly overdone. If you imagine that most of the quality house builders were buying land banks just after the financial crisis at next to nothing, effectively, they've been managing those land banks very well. We still know there's a supply in UK housing. They have been returning special dividends and generating cash and returning some of that cash to shareholders. And yet, the thing that prompted, quite apart putting the property funds freeze to one side, because that was, after all, a run on property funds as a result of concerns around the property sector. But the question, of course, is in terms of the UK, and I think we've spoken about this before, just how many housing markets you've got in the UK. When you've got the West End of London, where we had a lot of foreign investment, then you've got London, then you've got the South East, then you've got the rest. So which part of that property market are we actually concerned about?
From this point on, Richard, looking towards the second half and the end of the second half of the year, do you think the markets will be higher than they are at the moment, or is that too difficult to say, given what we've got between now and the end of the year in terms of other things happening around Europe as much as the UK?
Well, the most interesting thing is that investors are giving the market, the FTSE 100, a vote of confidence at the moment. What will become interesting is in 3 months' time, when we start to get quarterly numbers, both from companies and in terms of economic data, which will start to actually include the effect of Brexit. It's been easy for companies up until now saying that running up to the referendum, there is uncertainty, and therefore that's one of the reasons for our underperformance. Over the next 3 months, and then of course over the next 6 months, we'll start to get a really clear picture what that impact has been. And depending on that clear picture, as you can imagine, if it really has had a detrimental effect on a lot of those companies, that's going to be downward pressure.
Yep. Okay, Richard, thanks so much indeed. That's Richard Hunter there from Wilson King Investment Management.